When smart money moves, it leaves a trace. Every once in a while, something happens in the financial markets that cuts through the noise. Not a rumor, not a chart pattern, not a prediction, a verifiable real-world action, one that forces everyone paying attention to stop and reassess their assumptions. That's exactly what just happened in the silver market. Because a single private buyer, a billionaire with deep roots in technology and finance, has quietly accumulated roughly 13 million ounces of physical silver. Not paper exposure, not an ETF, not futures contracts, physical metal. That amount of silver represents a position worth hundreds of millions of dollars at today's prices. And more importantly, it represents real supply removed from circulation. This move didn't happen in isolation. It happened at the same time silver pushed to record territory. Vault inventories fell sharply and the paper market began showing visible signs of strain. And that raises the only question that matters. Why now? Why would someone who made their fortune inside the modern financial system make such a massive pivot into a physical asset and do it publicly? The answer isn't emotion, it's math. And once you see the numbers underneath the silver market, the move stops looking extreme and starts looking inevitable. This video is for educational purposes only. Nothing here is financial advice. Let's break down what's really happening. Section 1. The event that forced attention. Large purchases happen all the time. But purchases of this size, in physical form, are rare. Acquiring millions of ounces of silver isn't as simple as clicking buy. It requires sourcing real bars, coordinating delivery, arranging secure storage, and removing that metal from active market circulation. That's what makes this purchase significant. It wasn't designed for liquidity. It wasn't designed for short-term trading. It was designed for ownership. And ownership at that scale sends a message. Because when metal leaves the system physically, it doesn't just change who owns it, it changes what's left. Section 2. Why price is not the real story. Silver reaching new highs grabs headlines. But price alone doesn't explain behavior like this. If this were simply a momentum trade, paper exposure would have been easier, faster, and more flexible. Instead, the buyer chose the least liquid option available. That tells us something important. This move wasn't about price appreciation alone. It was about availability risk, and availability risk only becomes relevant when supply is under pressure. Section 3. The structural deficit. No one can fix quickly. For several consecutive years, the global silver market has been running a structural deficit. That means total demand has exceeded total supply. Not occasionally, but persistently. Year after year, more silver has been consumed than produced. Those deficits were covered by drawing down inventories, releasing stockpiles, and tapping reserves accumulated decades earlier. But inventories are finite, and once they fall below a certain threshold, the market loses its shock absorber. At that point, even modest new demand creates outsized effects. The system becomes fragile. That fragility is now visible. Section 4. Why silver supply doesn't respond to price. In most commodities, rising prices trigger rising supply. Silver is different. Roughly 2/3 of global silver production comes as a byproduct of mining other metals. That means silver supply decisions are driven by copper demand, zinc margins, lead production, long-term infrastructure cycles, not silver prices. Even if silver prices double, miners don't automatically produce more silver unless base metal economics justify expansion. And even then, timelines are measured in years, often a decade or more. This makes silver supply structurally inelastic. The system can't respond quickly, no matter how strong the signal. Section 5. Demand that doesn't back off. While supply is slow, demand is accelerating and becoming less flexible. Silver is essential to power generation, electronics electrification, communications, medical technology. These uses are not optional. Manufacturers can attempt to reduce silver usage per unit, but overall demand continues rising as production scales. And when silver is required for critical infrastructure, buyers don't walk away when prices rise. They compete harder. This creates a floor under demand that price alone cannot break. Section 6. Why physical ownership matters now. In a balanced market, paper and physical prices track closely. In a stressed market, they diverge. Paper exposure offers price tracking. Physical ownership offers access. When supply tightens, access becomes more valuable than liquidity. That's when large players stop caring about convenience and start caring about control. Physical silver removes counterparty risk. And at scale, it removes optionality from the market itself. Section 7. How the Comex system actually works. To understand why this matters, you need to understand one concept: registered inventory. Comex vaults hold a lot of silver, but only a portion is designated as available for immediate delivery. That portion is the registered category. Think of it as the metal that's actually for sale. When buyers stand for delivery and take physical possession, Registered inventory declines. And when it declines too far, the system faces a problem. There are far more paper claims than deliverable ounces. That mismatch is manageable until it isn't. Section 8. The recent inventory drain. Over a very short period, registered silver inventories experienced a sharp drawdown. This wasn't routine movement, it wasn't reclassification. It was metal leaving the system. Large delivery requests accelerated the drain, shrinking the available supply that backs outstanding contracts. When this happens, it sends a signal. Physical demand is no longer passive, it's assertive. Section 9. Why large buyers force the issue. When retail investors buy silver, it matters. When industrial users buy silver, it matters more. But when ultra-large buyers demand delivery in size, it forces the market to confront reality. They aren't speculating. They're testing the system. Every ounce removed tightens the constraint. And once confidence in availability weakens, behavior changes across the market. Section 10. The risk of paper-physical decoupling. The paper silver market assumes most contracts are settled financially, not physically. That assumption works until too many people ask for metal at the same time. When that happens, price stops being a discovery mechanism and becomes a rationing tool. The only way to slow physical demand is through higher prices. That's how markets protect dwindling supply. Section 11. Why this is happening now. This move isn't occurring in a vacuum. The broader backdrop matters. Investors are watching. Rising sovereign debt, persistent inflation, currency, debasement, geopolitical uncertainty. In that environment, assets with no counterparty risk regain appeal. Silver sits at the intersection of monetary protection and industrial necessity. That combination is rare, and it makes silver uniquely sensitive to stress. Section 12. The psychology of early movers. Large buyers don't wait for confirmation. They move when risk is mispriced. Early action feels uncomfortable because consensus hasn't formed yet. But once consensus arrives, availability disappears. This purchase wasn't about predicting the top. It was about avoiding the scramble. Section 13. Why this is different from past silver runs. Previous silver rallies were driven largely by speculation. This cycle is different. It's being driven by sustained deficits, industrial demand, physical withdrawals, and long-term positioning. That's why volatility feels different. This isn't excitement, it's tension. Section 14. What happens if inventories keep falling? If registered inventories continue shrinking, the system faces three outcomes. Prices rise sharply to discourage demand. Delivery delays emerge. Rules change to preserve stability. None of these are neutral for price. All of them reflect stress. Section 15. Why this purchase matters. Symbolically, a single buyer doesn't control the market, but large visible actions shift perception. They force others to ask, what do they know? And when that question spreads, behavior changes. Markets don't move on facts alone. They move on recognition. Conclusion. When physical reality takes center stage. This isn't about a billionaire, it's about what his actions reveal. Silver is caught between two unstoppable forces, growing industrial necessity and declining accessible supply. For years, paper markets masked that tension. Now physical demand is pulling the curtain back. When metal leaves the system, it doesn't come back easily, and once confidence in abundance fades, repricing follows. Not because of hype, not because of speculation, but because reality eventually asserts itself. The silver market isn't just moving, it's changing. And moments like this are how you recognize the difference.